Hello, everyone, and welcome to This Week in Hospitality Marketing, live show number 458. I'm your host, Lauren Gray. Greetings from the Netherlands. It is 5:30 my time. It is 11:30 a.m. Eastern, our live broadcast time in Eastern United States. And of course, to remind everyone, even though I am in the EU, we will be re-simulcasting this at 11:30 a.m. Wednesday morning. London time for our EU, and 11:30 a.m. Sydney, Australian time for our APAC friends. For everyone watching us live on the Hospitality channel, thank you so much for joining us live on your TV. If you're watching us on Facebook, LinkedIn, Twitter, YouTube, X, and Twitch, thank you so much for catching us on those panels as well. Sorry for the slight lag time getting connected. We had a little bit of technical slowdown for just a minute and had to wait. But anyway, we are into it now, and we want to get straight. I want to get straight to the point. This subject actually comes out from two dialogues. One is from our Hospitality Marketing Club. If you're not already a part of it or wish to be a part of it, it's a peer level group for hospitality marketers. Join us at hospitalitymarketing.club. All you do is put your email in. We send you a quiz. If you pass the quiz, meaning you're an active hospitality marketer by answering the quiz that tells us this successfully, I should say, then we will send you an invite and you join our closed walled garden of peer level communication, live guide, dialogue, and so forth. But out of all of those discussions came an interesting dialogue. We're well into the year, obviously, and we're going to be coming up on second quarter numbers. And as usual for our year, the first quarter, we start the year with all the prognostication of what happened last year. And the first quarter, there's a reality to it. And then we have this prognostication of the second quarter. And we're going to be coming to the reality of actuals compared to our prognostications on the second quarter, which always is fun because optimism gets tempered, get tempered, get tempered, get tempered. And then that's how we usually go. So I don't know why people try to believe in the optimism that the beginning of the year brings, because it is fictitious. We've never followed the pattern of what we promote as being what the year is like versus the reality of how the year comes through this. And in this case, and in no exception, we're faced with the same thing. We've had a good first quarter. I mean, and I say this in very general terms and very much domestically US, as I'm very empathetically related to being over here in comparison to the US at this point. And it's not been bad. I mean, there's been areas that have been not living up to what they've been doing, but there is a shift in how things have been going in these past, and I'll say this quantitatively, 6 months, and how they fear they're going to continue to go. Now, there is optimism that of course, there is still a very high demand for travel. The reality of it, though, is that's not translating in the same persistent demand that a lot of markets have had historically. They're seeing a shift of stronger rate resistance, less long-term bookings or lead bookings, more circumstantial rate sensitivities. So even though the general pontification is that there is still a great demand for travel, the reality of it is that it's not translating that way in persistency for people and places that have historically been the mainstream demands. There is a very big discussion we had on the Hospitality Marketing Club group about the K economy, meaning that those that have money are doing what they're doing. They're going in and having their experience-driven travel. They're doing the things that they would like to do. I have to say, being here in Europe this year again, it's remarkable to see on the social media how many of my acquaintances, professional acquaintances, business associations, and so forth are traveling in Europe right now, or traveling abroad in general, but tremendously in Europe at this point. Of course, obviously, this is an Olympic year, Paris being the focal point. We were just there a few weeks ago. So there's a lot of interest and attention to the European market right now. But again, from the K side economy, and for those not familiar with it, there K is because of the shape of the letter, not because it's an acronym for something, meaning that at the top of the funnel, you have a large functional usage of their finances, their monies. People that have money that are not stable in their income or not stable in their money flow, in general savings and so forth, or investments and so forth, they're spending as if things are quite fine, and they don't understand the problem associated with what people are perceiving as the economies right now, specifically the US, where a lot of people are in the mid-range and they are being squeezed. The cost of living has really exploited their options, especially when it comes to travel, which is why I'm bringing this up, because it is influencing what we think is the contrast of interest in travel is still high, but whose interest in travel as to who can actually do it. There's been some interesting statistics if you don't keep up with a lot of the news feeds that a lot of microloans platforms are exploding in usage, percentage-wise growth year over year. And if anybody's not familiar with microloans, those are people that are basically taking out a short-term, high-interest loan to pay for a trip, pay for meals, to pay for things. They just need the cash flow to pay bills of what they're still trying to do. There's also been some great indicators that the difference between the savings spectrum when we're in lockdown, which of course was artificial, to the savings spectrum now is incredibly different. Trillions saved during the pandemic lockdown, and now it's down to a fractional amount of billions. Dramatic shift in what people are saving versus what they're spending. And it's not in the contrite way that people are just being flagrant with their money. Yes, there are those. But it's the fact that the cost of living for people in the mid range of our economy, our middle income people, has been contrived. It's insurances are astronomical. For living in Florida, I can tell you firsthand, they are absolutely unrealistic into their growth expectations if you don't have the money on affordabilities. You have all the cost of goods, food, and so forth. And there is justifiable outrage that these are also the highest profit years for so many companies that are, oh, it's inflation. Yeah, it's not us. Yet they have record profits. So a lot of times these companies, as we're beginning to see more and more in the public perspective, are just exploiting the fact that they're using it as a reason to have raised their rates when there was no reason at all to have raised them, except for the excuse they can blame somebody else, inflation. This was a very long introduction to what will be a very short statement that comes from looking at data and the need to understand the data we're looking at. It is well known and it is persistent as much as whether you like it or not that money covers a multitude of sins. When you're making budget and when you're making revenue and the numbers that people are happy with, obviously they always want more, hence the margins of profitability. Then really nobody's really questioning things. Nobody's really scrutinizing things. Nobody's looking to squeeze that last ounce out of the juice or juice out of the orange. What is the analogy I'm looking for? The grape, last drop of the grape. There we go. Um, they're feeling that things are going well. Well, now that there's beginning to be ripples as to changes in demand cycle, rate resistances, less long-term bookings on people's books that they have had historically. Ownerships are getting nervous, and that ripples down quickly to management companies. Management companies then goes into properties operations. Operations leads into sales and marketing, everything else, and people are like, "So what's going on? We're good, right? Everything's fine. We're maximizing our opportunities." And you get a lot of head nodding of people. They get asked those questions. Sometimes companies, and I've worked with them, the first thing that they do is time to break out the whips, start cracking the whips. Let's start shaking let's shake the trees here, and let's start chasing people down and challenging people as to, are you sure that you're doing the most that you can, you're doing everything you can, the money's being spent the best ways possible, so forth and so on. And you get a lot of yes sir stuff, yes ma'am stuff. A lot of people are just affirmational. Yes, of course, everything's fine. Look, we're getting the money we're doing. Everything's going the way it's supposed to be going. Which leads me to the conversation of today. The conversation today came from a very active dialogue between people that were involved with marketing and revenue management and ownership and management operations and so forth, as to the disparity of how they saw things. So here's my topic, which took all of 6 minutes to get to. What numbers are you looking at? Now, I know it sounds contrived and very quaint to ask that simple question. What numbers are you looking at? Because it's not about numbers of forecasts of what people prognosticate as to the economy. It's not the numbers that we are talking about related to forecasts of the large scale of our industry or anything. This is the numbers related to your property. What numbers do you look at your property? And this came from a conversation where we were going through data dashboards associated with GA4, and we were talking about how to see data in the dashboards to use for marketing decisions, marketing performances. And we were trying to have a quasi beyond basic level discussion about trend. And you have heard me say about trend and pace on the show many, many times as true metrics necessary in the analysis work that you do for marketing, revenue management included. So then I started asking, in the collaboration between marketing and revenue management. What were common KPIs? And as I've mentioned in shows before and talked specifically about this in shows before, when you ask people what's the KPI, oh, revenue, of course. Yes, Captain, obviously, thank you. We're all in business to be in business, and revenue is the measure of whether or not we're successful at it. So get past the obvious. What are you looking at? There are strategy differences depending on the life cycle of a business. I have clients that theirs is primarily about top line revenue because they're looking to posture the properties into selling them. And it needs to show great cash flow, top line cash flow. Others are more into the world of retrieving and maintaining the investment into the property. There's the large FF&E or capital investment into the property. And they're less about driving hard occupancy, large scale occupancy for whatever revenue it can generate. Instead, they're looking to drive ADR and rate because they feel that they have invested into the quality of the product that they can now tier themselves or raise up the bars to what their rate integrity would be. Then you have those that are working on the downside of a property. They're not up for FF&E yet, or they're just prior to FF&E, furniture, fixtures, equipment, and so forth, improvements. And so they're looking to sell what they can sell at whatever rate they have to sell it at to get the occupancy cash flow that they need until they get to the time where the property goes under the knife. So there's different strategies which relates to the answer of a KPI, key performance indicator. And it isn't just about a top line gross revenue number. Sometimes it's occupancy numbers. Sometimes it's tier structure within your market that you're trying to balance act yourself to be available for people that are going to buy down and available for people to buy up. And there's a strategy about placement in the market. Of course, depending upon what companies you work for and so forth, you have the almighty RevPAR discussions as to how that is your KPI. Your RevPAR index is the measurement of success that everybody holds you to above your head on the food chain. So there's lots of ways to answer the question of what numbers you're looking at. But we're going to look at it from the more basic levels of occupancy, ADRs, and RevPARs, and revenue totals, top line revenue, because we can't really discuss flow through down to the bottom lines before EBITDA and so forth, because that's all moderated according to how you operate as a management company or ownership group as to your priorities and cost factors and how you've structured your labor costs and so forth. And other people have not problems. They have relationships with labor unions. They have relationships with contractors that modify what they're capable of controlling as the sense of the flow through. So we're not going to talk about those, but we are going to talk about what numbers do you look at in the measurement of what you do. And the first question is, what is the common vernacular between your departments that everybody acknowledges is the goals that everybody is mutually trying to get to? What I mean is revenue management. What are you looking at? What is your top line revenue goal for the month? And if you say your budget, just slap you now. Everybody loves to hit their budget. That fictitious number that you came up with over a year ago about what you thought you were going to be doing now as a guesstimate to satisfy ownership's demand on a higher growth pattern that you couldn't justify, but made the numbers work anyway. So skip that conversation. I'm talking about the numbers that are attainable and usable between the people that are actually boots on the ground, fingers on the keyboard, trying to generate the numbers that you all agreed were the goals that you had. Everybody would love to blow past budget. Everybody would love to think that they sandbag ownership to believe that they're only going to do so much and then go overwhelmingly better than that so they can hit all their bonus rings and everything else that they wanted to get, because ownership, gosh knows, extends that pole a little far with the carrot on it to make it mostly all the time unattainable. Once those KPIs are understood, marketing understands that revenue is looking for a revenue number goal. They might be honest to understand they're looking for an occupancy goal, an ADR goal. Marketing has its internal departmental goals. It knows it has to translate that production by certain numbers. Those numbers are based upon how many people they can get eyeballs on, or their eyeballs on your product that they can get in front of. So a lot of numbers that marketing relates to is audience size. That's usually translated into percentage of audience. And that percentage of audience is usually based on the audience that you can mathematically add up related to your destination, your product, your brand, events, all the things that drive people's interest in anything that you're related to. Those numbers cumulatively come up in your keyword selections, your content selections of people looking for it as a total audience. And then depending upon how many people you get in front of with your website and your advertisement, your social media and so forth, that is what's called your percentage of voice. How many people out of all those people that are possibly available to go over and purchase with you or be aware of you and want to be aware of you, how many people actually are aware of you? That's the percentage of voice that we're talking about. They also have internal numbers like ROAS, return on ad spend, which is a quantified ROI for marketing. It's just to say that what we're doing is we're doing it efficiently. I've also poo-pooed on this many, many times as being a self-serving number. You can outperform on ROAS very well, but still not come close to contributing to a larger goal that mutually everybody has as a KPI, which is top line revenue or occupancy or ADR. Just because you got a 20-to-1 ROAS on an ad campaign and only generated $500, who cares? The number's artificial. Yes, you did great. You spent a little bit of money, get a little bit of money for it, and it's a great metric number, but it isn't a production number that's chest banging proud to be a part of. So these numbers have to be understood. This is where my conversations with when I made this a topic for today's show begin to get spicy, because what we're trying to do, and I've made mention of this on shows prior to about reporting and data and so forth. If we were to look at the world of people that look at our data from a marketing perspective, excuse me, total audiences, conversions, channel contributions, and so forth. If you said that's 100% of the people that are touching it and are involved with it, 90% and more do not understand most of it. What they do understand is fractionally things that they've been exposed to persistently over time, that they understand the perspective of that number's value. Total traffic to a website is one of those things. How many people came to our website is a number that has been around for a while, long enough that most people understand the concept of what that means. That means how many people went to our website. Yay. Then the next one that most people understand, how many of those people went to our booking engine? People do understand the difference. Going to the website doesn't mean as much as if they don't go to the booking engine, because that's where they buy things from us. So there's this conversion number between those that came to the website and those that went to the booking engine. So already we've talked about three numbers. We've talked about the number of people in general that we have gotten from in front of our percentage of voice, which is traffic to our websites and all of our other stuff, ads and everything included. Then of that, how many people on our website went to our booking engine? Okay, so we have everybody that's out there, everybody that's seen us out there, and everybody that did something once they've seen us, gone to our booking engine. People so far understand these numbers relatively well as proportions and values, conversion values. X number of people came to our website, X number of those people went to our booking engine. That's a conversion percentage. 100% of people came to our website. Of that percentage, how many people went to our booking engine? And they also understand the next step, how many people actually bought. Okay, so they came to our website, went to our booking, and actually bought. And they know that the people understand that to be a funnel. It's been a beaten down topic title for such a long time. And for that reason, they understand that it starts really large. There was a lot more people that started this, down to the few people that actually purchased with us. And that people understand that. And they understand that the bigger the conversions produce, the better the revenue. There is fundamental cause and effect relationships that people do understand. And they also, for the most part, understand that there are certain channels, places that drive this traffic. Your Google ads drives traffic. Yes, Google ads is a channel. Your Facebook ads drive traffic. That's a channel. Your emails drive traffic. That's a channel. And then those channels go to the booking engine, hopefully, or at least a percentage of them do. And those people who buy, so they understand that progress. Okay, everybody that came from there went to the booking, then those people, some of those people went to the booking engine, some of those actually bought. They understand this. So that's called channel contribution. And they understand better percent of those conversions mean better opportunity for monies. So they understand these numbers. That is about as far as 90% of the people involved with this data understand. Those simple funnel metrics is about all they understand. Audience, website traffic, traffic to the booking engine, conversion from the booking engine. What channel, paid, social, CRM, drove it, and of that, okay, how much of that went to the booking engine, how much of that converted. And they also, let me be fair, they know that those channels cost money. So what is the cost for each of those clicks? CPC. Some people understand that concept. What is the conversion value, cost of acquisition? Sometimes people understand that number. But these simple three-step flows is pretty much what 90% of us of the people in our industry that have some engagement with the data we're talking about understand this process. And I'm being very general. Of course, everybody knows more. Some people, unfortunately, know less. But mostly everybody has a taste or a flavor of some aspect or component that they've been more frequently engaged with. Paid ad campaigns, knowing the variances of them, emails, knowing the workflow of them, so forth and so on. So everybody has tidbits of knowledge in here, but that's pretty much 90+% of the people. Friends of mine actually say it's higher. Ours, but the limit of their knowledge, three-step process, funnel operations. Then you have a small segment who, if we're going to say 90% of the people were that we've just talked about, then 8% of the next section, 8% of them reading 10%, are these next group of people that have a better working knowledge of some of the components associated with just the simple processes of these. They understand the much more granular variety of channel contributions, just like they know the production at their properties involves more than just the website. They understand, the correlation between transient group sales and so forth. That's all fine. Most people do in general. But these people understand things like geographic. Where did the people geographically come from? What is the demographic breakup of these people? Family orientation. This is groups of families with kids. Kids with what age? Are they married, not married? Single traveler, corporate traveler? The types of travel that are going on. People have a better understanding of that. They also understand a little bit more of the data metrics, the geo data of this, the traffic on a daily or weekly fluctuation. Okay, the difference in traffic between paid and social, and the interaction of timelines as to where social contributes more to paid's convergence and so forth, and converting. So those 8% of the people deal with a little bit more data. Those people should be much more in tune with this vernacular of common KPIs that are between all the departments. These 8% of the people should be your revenue managers, most definitely are your marketing people, and should be your directors and senior property team, the exec committee people at your hotel should be familiar, and they should be in this 8% range. Sadly, most of everybody I just mentioned is still in the 90% range. They don't get past that three-step funnel process understanding. And then there's a very small fractional part of data interpretation of some real number grinders. Again, these people should be your best revenue managers, corporate revenue managers, especially corporate marketers, corporate commercial officers should be in the very high 2 percentile of intimate knowledge of cause and effect custom audiences, action trigger items, trackabilities, channel shift, things we talk about here on the show. Now, it's easy, and this is where we get into dissension in our conversations with the club, that some people want to assign the 2% awareness as to people that actually are real grinders on numbers. They're the ones spreading out spreadsheets and creating cause and effects data sets and so forth. And then others just want to see it as a status of understanding that the 2% of the people are cognitively aware of all a much smaller minutia of the gears associated with how everything works. I like to think it's a little bit of both, because if you do understand the minutia of it, you tend to want to dive into the minutia more often than not to get past the tertiary answers that most data shows you. But this is what the topic of the show is mostly about today, is the fact, what numbers do you watch? And the unfortunate part is the three-tiered funnel process, you're looking at it from a post-action perspective. You're looking at it forensically. You're looking at what has happened. And the question that often comes from this is, what do you do with that? So you looked at the number of people that went to your website. Was that good or bad? Well, you ask somebody that looks at the number, and I have. And that's kind of where this conversation for the show today came from. Is that a good number or a bad number? Well, it looks like it's better than last month. Is last month the same as this month for you? Well, no, we're past spring break. We're going past. Okay, so the number's down, okay, compared to the last period, which was the month before. And yet, and you're saying that that's not good or that is good, but you're comparing against a time period that doesn't actually equate. It's not apples and apples here. You're just looking at sequence of time in an arc of what's been happening. Your traffic has gone down in this last month compared to the month prior to it, and you're saying that that's a good or a bad thing based on not a relevant contrast. That's when, well, look at the same time last year. Okay, was April last year the same April this year in the sense of demand to business? Some aspects, yes, they are. Some aspects, no, they weren't. Some aspects are different this year compared to what it was the same time last year. We're still dealing with the wrinkles of the impact of COVID and the wrinkles of inflation and what have you, economies. And now this being a political year, even more chaos. So my question to him is, what number, when you look at this dashboard of total production and traffic and so forth, what are the numbers you look at to assess whether there's something you need to look at more than just the number that started the conversation? And they just look at whether it's green, good, meaning that the number's bigger. And if it's not, if it's red, then that means that that number shouldn't be that number, because gosh knows people that made the dashboard put red when it's danger, danger, Will Robinson, and green is good, good, good. So they look for the red and greens and look for arrows up, arrows down. They look for contrast of what does that mean? Is that good? Now this is where we get into these conversations about what numbers do you look at. These dashboards, depending upon who made them for you, are made to the benefit of the person that designed them for you. Let's just say your agency, and maybe your internal team. And so they pick and choose the numbers that they want to show, obviously to you and in some authoritative position, to indicate success. So wouldn't they pick the numbers that would show that? But are they the relevant numbers that you would need to know to make actual decisions from? For instance, comparing yourself in traffic period over period. It's like watching the stock market and say, well, it's not as good as this month as it was last month because my traffic to the stock market is down. Did your value go down? Well, I have no idea. I'm just talking about traffic. So really, that's a not relevant number. If you want to look at your traffic compared to year over year, which is a much more sustainable conversation, and say, well, we're having less traffic this year. Okay. What's the next question past that? Is it good or is it bad? Because then you're down now looking at your conversion numbers. Well, our traffic may be down, but our conversions are up. So maybe then you want to look at ads. Maybe we're getting better efficiency out of our ads. We're spending less on our ads, generating more revenue from what we are spending, but we don't have to spin the wheel, so to speak, and drive that much more traffic to do it. Maybe it's not a bad thing. Maybe it's a good thing. We're getting more efficient in our conversions of the traffic that we do have. We're spending less monies driving irrelevant traffic. If you look at the contrast between conversions, this year, our conversion is higher than last year. So even though our traffic is down, we made more money. And now let's look at what we did to make that money or make that revenue and see whether our costs went down correspondingly. Say, wow, we got better at this. We got more efficient. We didn't have to. Last year, we were driving more irrelevant traffic to our website. Traffic was up than this year. And we're making more money than last year because of it. That's a good thing. Reverse is true. We're doing less traffic and we're making less money. Wow. So what we were doing to drive more traffic last year is not working as well this year, or we're not doing the same as this year. And because of that, we're also not making as much money this year. Something to look into. I can honestly say these discussions don't happen in real life. These discussions are glazed over in a monthly recap between those people that created the reports and the people that asked for the reports in such a way that it is a shell game of look at this shiny number, ignore this poor number. Or we put this number in here in a PowerPoint deck presentation, which is always flexible, whatever we want it to be, to highlight things that aren't necessarily as valuable to you as other numbers, but the other numbers do not shine a positive light on some things. And this happens a lot of time because of this monthly attribution of forensic review of data. If you look backwards on the previous month, looking at what happened, and say, wow, we should have maybe changed our ad campaign 2 weeks ago because it was already taking a dump. but we didn't because this is the first time we're looking at it at the end of the month because that's what the client wants. The client doesn't ask, who cares? So what happens is what should have been solved in a 2-week repair takes 2 months. The month for the incident to happen, the end of the month for the awareness of it to be there, and the efforts to correct it, only to see it at the end of the next month whether it was corrected for. Now, that's saying that you actually corrected it correctly the first time you discovered it after a month of it being wrong. If it didn't get corrected correctly, then it adds another month to try the next thing that didn't work after the second thing. And this is the world that a lot of ownership groups deal with. And they don't even know they're in a rut that is, they don't even know they're in Plato's cave. They don't even know they're looking at the shadows and there's a real world elsewhere. They don't know that there's any way different than this. They just know, well, this is terrible. That problem that we found a month ago, we asked them to correct for it, and they said this is what they're going to do. We thought that sounded right, so they did it. And then now we're on our next report. It didn't have the effect we wanted to, so they're giving us another recommendation. Guess what, Einstein? At the end of the next month, they're going to find out whether that also is a crappy suggestion to it, and you're spending another month trying to figure something. Meanwhile, you've not solved the diminishing value problem of your ad campaigns. You've only allowed it to be exacerbated and extended. This is the world that a lot of places work with. Vendors are quiet because the client isn't asking. Client's not asking because the vendor's not sharing correctly. And so you get this stigma, this stale conversation that goes on for several months. And people wonder why they get frustrated with their vendors. Vendors get frustrated with their clients. And things begin to unravel and they start sending out RFPs looking for other services to replace them with, only to rinse, wash, and repeat the same process after they go in, make some changes. And I see this persistently. We've created some interesting dashboards that use the health data of what we're looking at. We're looking at conversion value, lifetimes, and so forth. And we're looking at this to monitor the production of channels. And we watch the deltas indicating whether there's something happening. Now it's still doing well, but the deltas begin to show diminished impact of that campaign before it begins to really draw down the positive impact it's having on, say, revenue or whatever its goal set was for. So say, for instance, you have a holiday event and the holiday's in the earlier part of the month and the holiday event runs throughout the mid part of the month. And of course, because of how it's labeled and what it's offering, maybe windows of dates that were available for it to be bought, you're well past that. So all of a sudden, campaign's values begins to diminish because people, they're not finding the inventory anymore. The offer isn't for the dates they're looking for. So it's losing its impact. Without having the next thing to replace that with, it falls off. Then there's a gap. Then there's a meeting. The meeting shows the gap. The meeting asks for what are we going to do to fill the gap. Some suggestions they'll come back to. It's like, well, now that you pointed that out to us, we'll do this again. They come back the next meeting. They offer some suggestions. Sometimes it's delayed. We'll get back with you what we decided on. Once it's decided on, they go over and take the suggestions. By that point, the suggestions may be stale and or no longer relevant. And they implement them. The implementation doesn't go well. The fix doesn't work. They go back to the beginning of the conversation. This goes on and on and on. And as long as the representative of the company isn't held culpable, as long as the vendor's not held responsible, the people that pay the money, the owners and so forth, don't understand. They think they have everything in place. They have all the tools. They have the vendors. They have all the programs. We got our paid campaigns, right? We got our OTT. We got all this stuff. Why are we not getting more from it? And then there's this warped distortion as to how much that actually contributes to the bottom line. For instance, if you're a direct channel, which, by the way, to this day, I've never had a property tell me accurately what the direct channel percentage contribution is because they don't know. Some of it's partially because of the variance in what people interpret as part of what contributes to direct channel. And the other is they just don't know. They're always also wrong about their OTA contribution. They always estimate way less than the actual OTA contribution, without fail, without exception. Nobody's ever got it right. A couple have gotten it close, but they never got it right. And they've never been clear about their direct channel contribution. I say that because then there's times where their total month revenue goal is really taking a dump. And they're 3 weeks into the month with 1 week left, and they think that they're just going to throw a boat ton of money at paid ad campaigns. But their paid ad campaign is only 4% of their total revenue growth problem for the month. no matter how much money you throw in, how much you want to spend for that percentage of voice of people that that advertisement could get in front of, that will never fill the full void that you're asking it to when it's at such a fractional value of contribution to begin with. You can't you can't dig the Grand Canyon with a spoon. Well, you can, but it's going to take a lot more time than you have. So that's the problem of this convoluted perception of channels, channel contribution, channel impact, and numbers that are related to what numbers you're looking at to know whether or not those are the numbers you need to make actual statements on. We went through some exercises with some conversations, and we talked about pace, we talked about trend, we talked about the impact of CRMs, email sends, and whether or not you got the second bump off of your email or didn't get it off. We talked about reviewing all of your price policy performances as to are all your rates active and correct for the inventory that you want? Are you early selling your high demand inventory too soon at lower promotional rates? And it's exacerbating your ability to yield your better inventory at higher rates, knowing you could sell it later in the buying cycle because people want that inventory type. So offer your less desirable or higher volume inventory that you have latitude with out early on your promotions to build that base business for compression, and reserve your high demand inventory types for your high rate business. It's about revenue management, and revenue management talking with marketing and talking about what numbers they understand both ever are working for, what KPIs, and what's the modality. Revenue management needs to understand the numbers that marketing uses, and marketing needs to understand the numbers that revenue management uses for it to be a collective entity to work efficiently together. Now, years back, I was on the vanguard in the soapbox about siloed departments and needing this collaboration between departments. And fortunately, COVID woke everybody up because they fired half of the equation. So whoever was left over had to assume both mantles. So if they kept their marketing person, they had to become a revenue manager. If revenue manager was kept, then they had to learn more about marketing. So there's less of a discussion about this siloed perspective. But unfortunately, and we've talked about this in the show before, there's a lack of education of somebody being qualified to do both. And they're in a position that they can't admit that they don't know what they don't know. And so they fake it. They nod their head when they should be asking a question. They should be questioning when they're just blindly accepting. And they should always challenge the people that are doing what they say they're doing with validating how they're doing it with numbers that they all agree on. And that's the vernacular of the common KPI. So to that, I'm going to leave our conversation on the point of what numbers are you looking at? And that's the value proposition of the communication you need to have between your departments and your vendors, or those that are responsible for the enactment of all of your policies, marketing wise and revenue management wise and everything else. So again, thank you so very much for the privilege of your time. If you have any feedback, please, I always answer every email according to the show. Lauren@hospitalitydigitalmarketing.com. If you want to do an audio feedback or answer my question of the week, you can do it at hdm.news/talkback. I put a question up every week for people to go over and give feedback and give me their permission as to whether I can refer to it or not. Our podcast today, we'll be talking about interpretive numbers, creating APIs that will pull data sets into different sheets that then can be used to create correlations. So you can get some trend analysis and paces and so forth, and a little bit of Looker Street, but there's some cool tools that are associated with it. So we'll have that talk in our podcast today. For everyone watching again on our TV channel, the Hospitality Channels, thank you so much for watching us on your Roku TV, your Google TV, your Apple TV, Samsung, LG, whatever. And if you watch your media on Twitch, thank you so much for watching our Twitch broadcast. And of course, all those that watch us on Facebook pages with all of our associations that we are with, that we broadcast with, and business partners that we broadcast with, and so forth. Thank you for the privilege of putting our broadcast on your page. We get a lot of engagement from that. Thank you so much, as well as the YouTube channels that you all run. There is only one LinkedIn broadcast that we do, which is on my profile, Lauren Gray. There you can put me questions as well in comments. And of course, X is, we're also simulcast on that as well. So until next week for show number 459, my name is Lauren Gray. And again, I wish to thank you for the privilege of your time. We'll see you all next week.